In this session, we're going to be focusing on managing audit risk. As we've talked about in the prior presentation, audit risk is the product of inherent risk, control risk, and detection risk. The two elements that we're going to focus on in this lecture relate to the inherent risk and the control risk. Keep in mind that our goal as it relates to managing audit risk is that the auditor does not want to issue an unqualified opinion when in fact there are material errors within the financial statement. So what we look at is we look at these three areas: inherent risk, control risk, and detection risk. So the detection risk is the level of audit effort that the auditor will expend on the engagement. This clearly is going to depend upon the risk of material misstatement. And as we've talked about, the risk of material misstatement is dependent upon the inherent and the control risk. So when we think about this from a qualitative perspective, when the risk of material misstatement is high, we're going to lower the detection risk. We lower the detection risk by increasing the quantity and quality of evidence through our substantive procedures. Keep in mind that we manage the detection risk based upon the nature, timing, and extent of our substantive audit procedures. So let's focus initially on the inherent risk. The inherent risk is based upon the account level as well as the assertion level. Factors that indicate a high level of inherent risk include accounts that represent an asset that can easily be stolen. So as an example, cash is inherently a risky asset. Account balances that make up complex transactions, account balances that require a high level of estimation to estimate the value, account balances subject to adjustments that are not part of the ordinary processing routine, and account balances composed of a high volume of non-routine transactions. So when you think about the term inherent, what you want to think about is what is the nature of the account or the assertion level that we're looking at. The nature is what is it about this account that creates risk. And in this case, the risk is defined as the inherent risk. Inherent risk at the financial statement level. At this point, we're focusing on business risks. Inherent risk at the financial statement level that affects business operations and potential outcomes of the organizational activity. Examples of these include overall economic climate, the technological changes that are impacting the organization, competition, as well as the geographic location of suppliers. The risk assessment procedures for assessing business risks. So again, when we're looking at business risks, we are considering this concept of inherent risk. So what are we going to do? We are going to make inquiries of management, review the client's budget. Certainly as we review the client's budget, is identifying variances are going to provide a cue in terms of where the risks are within the organization. Tour the client's operations. Anytime we do walkthroughs like this, is what we're attempting to do is gain an understanding of what's taking place within the organization. Review governmental regulations, any legal obligations, have a knowledge of the management systems that they're using. Certainly we want to understand the economic background related to the economic climate as it affects the industry. We would be looking at stock analysis reports, company earnings calls, all of these things that essentially give us an understanding. Many of these things are going to be a qualitative understanding of business risks. At the inherent risk level, financial reporting risks include things such as, when assessing this risk, the auditor considers all items on the company financial statement that are subjective and based on judgment. Inherent risk at the financial statement level is affected by the competency and integrity of management, potential incentives to misstate financial statements. So what we're looking for is we're looking for things that may be taking place that are going to impact management's decisions, primarily related to estimates and some of these non-routine transactions. So how are we going to understand this? We're going to make inquiries. If there's a predecessor auditor, this is one of the things that we're interested in finding out from the predecessor auditor, is issues related to management integrity. Other professionals in the business community, other auditors within the firm, management, audit committee members, federal regulatory agencies. We're certainly going to do a review of key executives as well as the organization on web searches and public databases, and see if we can understand what is it about management that indicates that they have a high level of integrity, or maybe they don't have a high level of integrity. And why are we interested in integrity? Well, integrity is really going to drive the ethical framework of the organization. So as we have talked about in the COSO model, we're looking at the control environment. Part of this control environment is this top-down approach, and this top-down approach is driven by the ethics of the organization. Factors indicating a high level of inherent risk at the financial reporting level, discrepancies in account records, unusual relationships between the auditor and management, lack of management competency. A couple of other things is if an auditor has resigned, it's very possible that, or this may be an indication of issues related to management's ethics. Unusual transactions with outsiders or significant related party transactions may in fact be a risk level as we are considering inherent risk. When we talk about inherent risk, we need to understand it from the perspective of assessing fraud risk. Well, how do we assess fraud risk? Well, as we are attempting to gain an understanding of the organization at the auditor level, what we want to do is we want to come together as an audit group and brainstorm. A group discussion designated or designed to encourage auditors to creatively assess the client's risks, particularly those relevant to the possible existence of fraud, is a very good starting point in terms of understanding what could happen. We need to do this at the early stage of the audit, because what this is going to do is this is going to help us plan very specific steps in the audit process. This brainstorming session should be attended by the entire engagement team and led by the audit partner or manager. Other procedures are going to be inquiries. Again, it's very important that we make specific questions to management and other people that we are interviewing specifically related to fraud risk. So we've talked about inherent risk. Now let's focus on the control risk. Control risks relates to the susceptibility that a misstatement will not be prevented or detected on a timely basis by the internal control system. So independent of our understanding of the inherent risk, what we're looking at in the control risk is what management is doing to mitigate these potential risks or these potential bad things that may happen. The assessment is made at the overall financial statement level as well as at the account or assertion level. And again, the controls are going to be driven by the inherent risks that we have identified. Factors leading to the assessment of a higher level of control risk. And again, keep in mind that the greater intensity and quality of internal controls established by management is going to lower the control risks. So when we think about high risk, a couple of things that we're considering is poor controls in specific countries or locations, difficulty in gaining access to the organization or to those in control, little interaction between senior management and the operating staff, a weak tone at the top and poor control environment. Again, back to that COSO model that is absolutely critical for us to understand as we are assessing the organization. Inadequate accounting staff and information systems. The growth of information that exceeds the accounting department, or disregard of regulations for the prevention of illegal acts. The organization that is actually experiencing a rapid growth creates risk factors that management needs to mitigate through internal controls. But if an organization is in fact growing and it's straining the organization to support this from an accounting as well as a control perspective, this absolutely is going to impact the control risk. Now you notice the last piece is no internal audit function. There's no question but that internal audit is part of this COSO framework. Organization has either no internal control department or an internal control department that lacks the skill set and the independence. This in fact gives us a cue in terms of the control risk of the organization. Risk assessment procedures as we are assessing control risk. We're going to interview relevant parties to understand the processes used by the board and management to manage risk. Review risk-based approaches used by internal audit with its director and audit committee. Interview management about risk approaches, risk preferences, risk appetite, the relationship of a risk analysis to the strategic planning. So you notice these interviewing functions, these interviewing areas that we're looking at are very similar to the enterprise risk management approach that we talked about in another presentation. As we're looking at internal controls, one of the things that we need to understand is that we're looking at internal controls from the perspective of transactions. So as we are developing control procedures to understand the internal controls, we're looking at it from a transactional perspective. Now we want to also spend a few minutes talking about analytical procedures. Using analytical procedures as a risk assessment process can actually help the auditor gain an understanding of the risk of material misstatement. Analytical procedures improves the understanding of the client's business. It helps identify risks of material misstatement, in particular related to account balances, and it directs the auditor's attention to high-risk areas. Examples of planning analytical procedures. The auditor may develop an expectation of revenue based upon production capacity. So we may be able to back into revenue based upon the amount of production, based upon the amount of cost of goods. And again, we're using analytical procedures, or we're simply using a mathematical model to get to this point. Recorded revenue in excess of this expectation may indicate a heightened risk of misstatement on the revenue account due to either fraud or error. The auditor will then want to plan audit procedures to obtain sufficient appropriate evidence for the revenue account. So as we talked about, the analytical procedures helps the auditor gain an understanding of the risk of material misstatement. But let's talk specifically about what analytical procedures are. Analytical procedures are nothing more than mathematical models. These mathematical models could be trend analysis. This is based on the history of changes in the account or ratio. Ratio analysis. This identifies relevant ratios to determine whether there are significant differences between the client results and auditor expectations. Here's just some examples from the book based upon some ratios that we might consider using. And again, you should become familiar with these because these are nothing different than what you would see in a financial statement analysis course. But again, why are we doing this? Well, we're looking at these ratios so that we can understand where there might be risk areas. So we're considering this from the perspective of what these accounts, what these ratios look like from prior periods, also based upon industry standards. We're also looking at these ratios to recalculate the results and determine whether or not the numbers that the organization is putting together is reasonable at this risk level. The reason we are considering the inherent risk and the control risk is to determine our level of detection risk. So detection risk is affected by the effectiveness of our substantive audited procedures that we perform and the extent to which these procedures were performed with due professional care. The auditor should determine whether the audit will be controls reliant audit or based upon substantive testing. And again, keep in mind that the substantive testing is where we measure monetary misstatement. It's very possible that the auditor can in fact disregard information based upon the inherent and the control testing and simply rely on the substantive procedures for the entire testing. Planning audit procedures to respond to the assessed risk of material misstatement. We need to evaluate the reasons for the assessed risk of material misstatement, estimate the likelihood of material misstatement due to inherent risk of the client, consider the role of internal controls, and obtain more relevant and reliable evidence with increases in assessed level of material misstatement. The response to the risk of material misstatement is the nature, timing, and extent of these further audit procedures. And again, these further audit procedures, as we are measuring monetary misstatement, are the ones that we describe as substantive testing. So our response is, based upon the nature of the testing, what type of audit procedures are we going to use to manage the detection risk? When are we going to perform these procedures, whether immediately at year end or as part of the earlier stage of the audit or after the conclusion of year end? And the extent of the response is really defining the amount of evidence. So very simply stated is the higher the risk, the more audit procedures that we're going to perform, the greater the sample size that we're going to use as we are attempting to manage the detection risk. So in this lecture, what we've done is we've defined the risk of material misstatement based upon the inherent risk and the control risk. The risk of material misstatement determines the nature, timing, and extent of our substantive procedures. We're using these substantive procedures to measure monetary misstatement. The last piece that we considered related to how we can use these analytical procedures or these mathematical models to help us understand the risk of material misstatement. Thank you very much for your time.